Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, and I have Jordan Terry on the line, and he is founder of Stone Street Advisors. Jordan, how you doing this morning?
I'm doing pretty well despite the dreary weather. It's a good day.
Okay, all right. Just tell us about a little bit of your education and your market background, and how you ended up at Stone Street Advisors.
Hey, I started following the markets around my bar mitzvah, actually, when I was 13. And that was the first time I told my dad to buy Apple, and I think it was trading around $7 a share back then. I followed it the markets throughout high school, made my first investments during the first before leading up to the first tech bubble. Actually made money in XM, lost money on Cisco, but learned a lesson the hard way at a relatively young age. Bachelor's degree in finance from Penn State and some coursework in engineering, and I'm finishing up my MBA at NYU as we speak.
So, how old
Uh,
are you, Jordan?
I'm 31.
Okay, all right. So you do have a history in the markets, being only 31. You still got your Apple stock?
We have some of it in some family accounts. It's
Okay.
not quite a $6 cost basis, but it's relatively well.
That's all right. Average up. That's always a good thing to do. So before we get into talking about your investment research that you do, just could you just kind of give us a little bit of the psychology of the markets right now and how the average investor is feeling out? A lot of people have been on the sidelines during this, and also you have some fund managers that haven't had the greatest performance either. Could you touch on that?
I don't know if I'm the best person to talk about a quote unquote the markets. It's some sort of anthropomorphic, creature that has emotions and highs and lows. But broadly speaking, for the individual investor, I tend to be in the index investing, passive investing sort of school. The average professional can't beat the markets, so there's not really any chance that the average non-professional is going to beat the market. Nothing wrong with putting, aside some play money to trade with or invest with, take some long shots with, learn, a little bit. There's nothing wrong with that. But every day it seems I see more and more people, whether it's on stock twits or some of your, financial websites or blogs, and or you see it on CNBC all the time. People, calling in like they read one article about a company and I think they've been following it for years and have done some sort of deep dive on it. And more often than not, the numbers don't lie. People get taken for a bath when they do that. There's nothing wrong with learning, but I mean, it seems a lot of, people are still looking for shortcuts these days. Shortcuts aren't there. They don't exist.
Okay, all right. So we can move on. Let's talk about your investment research and consulting that you do for institutions. What are the basic tenets of your research?
Uh, we work from purely fundamental, no technical besides, we pay attention to price and price action. And, if the stock has been trading all over the place and we think the fund valuation is X and it's been bouncing around, with some huge volatility, we're not going to tell a client to get in, whether it's long or short. But in terms of our research, it's all fundamental, bottom up. We pour through the financial statements. We read all the exhibits, the credit agreements, the purchase and supply agreements. We go out, we check merchandise, we check stores. We talk to people. We sit in front of Excel and stare at very large spreadsheets and pound our heads on the desk a lot. Doing fundamental investment research is really not sexy at all, but having good returns and a good track record, I think, is pretty sexy.
Right. So you won't pay attention to any. I mean, you pay attention to price. Price don't lie, but you don't. As far as like technical analysis, it's just not in your wheelhouse. Not to enter or exit a stock. You just basically the fundamentals and the price where you should be trading at, and make your decisions based on that.
I mean, I can look at a stock. What am I looking at right now? Like I have a couple stocks in front of me. Like if you look at like New York Sports Club, CLUB, if the company is a disaster, they're getting squeezed from all sides by these low-cost competitors charging $20 a month, giving away free pizza Tuesdays. And they're being squeezed at the high end by like the Equinoxes of the world. And they have really high fixed costs. But there's an activist hedge fund investor involved. So you have all sorts of, I guess this is a mean word, but I guess parasite traders jumping in, driving the stock up and down, like 2, 3, 4, 5% every day. My fundamental valuation of the stock is irrelevant if the stock price is going to bounce around like that. So in that sense, I do pay attention to price. I do pay attention to how volatile things are and how they're trending. Volume is important. If you look at a company like Overstock, I've spoken to some activist hedge funds about that. And, one of the biggest problems that we've encountered is they can't build up a sizable stake because there's not enough volume there. And if they did, someone would surely pick up on it, and then you would see it in the technicals. It'd be crossing Bollinger Bands on day one. Yeah, so I do know a little bit about this stuff. I just don't use it that often.
So you put out something on Overstock.com today, and could you talk about your thesis on that stock, OSTK, for our listeners?
Yes, this is one that we middle of this summer, late July, we were screening for companies that we thought would be private equity buyout candidates that were undervalued. And we thought, a lot of cheap debt floating around, a lot of cash on companies' balance sheets. Surely there's got to be some companies that are easy private equity targets. And we put together a couple stock screens. And we found a bunch of companies we kind of expected to find, industrial companies with hard assets, closely held family-type companies like Wyco. But then we found Overstock. At first it was like, what the heck is this doing here? And then we started, looking around at it. And we're like, they have $100 million of cash on the balance sheet. They have no debt. They were doing, all I knew about Overstock before it came up was that my mom bought a bunch of furniture there. And that, the CEO had done some kind of crazy things over the past couple of years. There's been some accounting issues. The company's not exactly well run. There's been a lot of lawsuits, et cetera, et cetera. So it was the first time that I ever really took a look at the financials and how the company was doing. I didn't realize, they were, doing over $1 billion revenue a year. And, when we first started reading what other people had wrote on it, reaching out to some of the other journalists who covered it over the years, guys like Roddy White, Gary Weiss, Herb Greenberg, and some of the fund managers who have been involved over the years. It was a major caveat emptor, buyer beware. Be careful, what you get involved in here. This thing's probably going to, there was not so much positive there. But the more we looked at it, the more we realized that everyone hates this company. No one wants to buy it. There's only one institution left in it. All the other friendly holders and big institutions are long since gone, years ago. Everyone's kind of kicked to the street. Everyone's given up. And from the fundamental school, you read people like Seth Klarman in Margin of Safety. Several times he mentions directly or alludes to the fact that some of the best opportunities come when other people can't look, either because the stock is thinly traded or too low price, or too low of a market cap, or just because it's something that's fallen out of favor. And sometimes that's where we find opportunities, and that's what we think we found in this one. A lot of people think that the CEO, the founder, Patrick Byrne, is, for lack of a better word, kind of a lunatic on a mission, a vendetta. But, we think the underlying business is really strong. They have a really strong brand when you start to ask people. You or I may or may not be in the target demographic of, 20-something to 50-something, females in the middle of the income bracket. But when you talk to people who are in that, they're really positive about it. They don't know anything about the company itself. So that made me think, maybe there's something to this. Maybe there's more of a story. Maybe this company is not just something that I should dismiss at face value. So we looked into it, and we think this company could be worth 10 times what it is now. It's trading around 24 or so, and we think, in our more optimistic cases, that this thing could be trading north of 250. A lot of things have to go right for that to happen, but if you look at, we did 20 different scenarios using a discounted cash flow analysis, and the average valuation we came out to was $82 a share. And from $24, that's 238% change over where the stock is now. So assuming management doesn't completely run the company into the ground, if they just ride the wave of consumers moving to buy more and more things online, people my age and younger, no one wants to go into a store anymore. If we can buy a couch or an end table online, and we can see what it looks like in a room, from the way they have it on the website, we'll buy it, especially if it comes assembled. So that's a trend that's just increasing. Right now, online penetration for home goods is only 7 to 10%. You look at apparel, it's 15, maybe even 20% for certain things. Over the next decade, if online home goods gets that sort of penetration, look at a market going from not doubling, right, $17 billion to $45, $50 billion. If Overstock keeps its relative position in the market, that's a couple $1 billion in incremental revenue just by standing still and doing what they do. Success by accident sort of thing.
Okay, all right, that's a great explanation. We just got some breaking news here. Activist is to buy Allergan, and you can look at the numbers there in the chat. Jordan, will you ever use your analysis? Like here you are, you're evaluating companies, you're looking at the balance sheet, the merchandise. Will you ever use your analysis in reverse and short stocks?
We do long and short, actually. Big fan of shorting, actually. Major fan. If you look at the 24 ideas that we've had since we started, see how many of them have been short. 1, 2, 3, 4, 5. Yeah, half of our ideas, coincidentally, since we started in 2011, have been short ideas, actually. And our short ideas actually outperform our long ideas, even though we've been in an up market.
Okay, all right. It's good to be diversified. And do you use options as part of your strategy at all?
We generally stick to the underlying equity, but if you can leg into a trade using options easier, to replicate a short, with less. If you can buy a put and roll the put, longer term for cheaper than you could, trying to find that a significant amount of shares to short and have to keep marking, the position every day, then, we'll definitely discuss with clients or potential clients using options. But in terms of valuing options, pricing options, or, option-specific strategies, we don't really use them. Although in certain situations I have talked, with clients, potential clients about, hey, this, looks like a really interesting play, but coming into earnings, we can have XYZ, long-term outlook on the stock, but going into earnings, this thing could go up or down 15% in a couple minutes. The market's not expecting that. You can put an at-the-money straddle on for basically nothing and capture some of that and reduce your long-term volatility or your long-term exposure and maybe make a gain in the process. So we talk about it, but it's not really what we're focused on.
Okay, and do you do any overall hedging on your portfolio?
We don't manage money as a matter of principle when we started. We didn't want people to say, hey, you're just talking your book. In hindsight, I probably should have just tried to start a hedge fund instead, but that's another conversation. So we don't manage any money, so we don't do any hedging, but again, it's kind of similar to how we look at derivatives. Okay. And kind of how we look at technical analysis as well. If we have a 1 to 3 year view on a company, you look at T-Mobile, for example. It came out with a bullish report on T-Mobile last November, about 13 months ago. And, the idea was that Deutsche Telekom wanted to sell their stake. There's a lot of M&A activity going on, and the company is restructuring. and we're bullish on the company long term and standalone basis. You got all these other things going on. How do you hedge, your volatility there? Even though we have a long term outlook, what are we going to do in the short term? So it's something we think about, but it's not a primary concern. I mean, I think generally speaking, anyone in the markets, whether you're fundamental, technical, or whatever, if you're not thinking about what can go wrong, then you don't deserve to ever be allowed to touch money, yours or anyone else's, in my opinion.
Okay, Jordan Terry, founder of Stone Street Advisors and managing director there, giving us his outlooks and his approach to the markets. Jordan, thanks for coming on. Great information. We hope to speak to you again.
Thank you so much. It's a pleasure.